If you're looking for professional day trading education and high-level trade analysis and dissection, you have come to the right place. My name is Pat Mitchell. I've been a professional day trader for the past 11 years, and I'm here to bring you exactly that. Professional day trading education, all here for free on YouTube and on X. And tonight we are going to be going over two specific trades that I took, and we're also going to be doing a detailed lesson on really quick, fast confirmation. And you'll understand what I'm getting at once we get into the chart. So let's get into this. Let's get cracking, folks. It is Friday. And here we go. So hopefully everyone had a great day. Let's get into it. Specifically, we were working with Qs here today. For those of you that are joining us, these blue levels are struck prior to the market, not after the fact, placed for the market. And then I designed trades surrounding these levels, contingency plans, which mean just in case it doesn't work. There's always a way that we can manage the trade out. Sorry, I just had a glitch on the, there's some rain going on. I don't know if it's a storm or what. We'll get through it here. So on this here, the trade plan was to allow this level to fail. Okay, that was the original trade plan. We could also, if done correctly, take it short coming into pre-market highs. Now, there was risk associated with that because of us gapping up yet again. When we are hovering near all-time highs like this, most traders, most retail traders will hold overnight looking for a gap down, which then creates big squeezes, which ultimately what happened once this level held, this 584.08 level. Once that held, lights out, this thing's going to squeeze. And sure enough, it did. But on the short side of it, if we get a pop and there's a bunch of sell volume right into that area, or it's just a small amount of shorts that are getting squeezed, there's a way to look for confirmation. It happens very quick, but I'm going to show you exactly what that looks like. I'm going to zoom in a little bit further here, just so then you guys can really see what I'm talking about. I'm going to stretch this out. And let's do this. So remember, this level here is pre-market highs. It is an important level. Okay, so that was kind of horrible. Let me just draw it a little bit closer. There we go. So the market opens up and it pops. It gets through. So it punches through and completely disrespects that because there's a bunch of shorts covering their positions from stops blowing off. So basically, that's what this initial candle is here. It just stops blowing off, okay, on the short side. So in order to cover a position, it gets bought. So immediately, once it pulls back, so it pushes, and once it pulls back to test that level, that's important. It's an important level, okay? If it holds that and remains above, it is immediately deemed weak, okay? Or strong, sorry. If it holds that, it is deemed strong, all right? There will be orders there, and people will pull the trigger to go long. Now, I'm not looking to go long way up there, okay? So when it pops and fails all within the same candle, this candle right here, the first candle, it closes. Next candle opens. That's what you need to pay attention to. That next candle is going to push up and retest this resistance level. It will. It does it all the time. And if you're really smooth, real quick, real focused, you'll see when it comes up, it immediately rejects. That's your trigger. Now, I'm not saying that this is a beginner trader setup, nor even a novice trader setup. It requires an extreme amount of focus and knowledge of price action and how it moves and why. Not just it moving, but why it moves the way it does. Okay. So on that candle, execute the short. That's my entry right there, right at the top, right there. And then from there, all you simply do is your stop is set above that on confirmation. It would have to confirm. It can't just barely crack that. It has to truly confirm higher than that. That would be the stop. So it's a very tight stop trade, right? You only actually really had about, I would say by the time you stopped out, 40, 50 cents worth of risk on that. So very tight. So execute the trade here upon that very quick, fast confirmation. As it comes down into here, the opening price, you pay yourself. Comes down into here, you pay yourself more. Now, there was an opportunity to take a quick confirmation trade, which is right in here. So it washes, opens up, next candle pops up. It also confirms. I call this a head bump. So there was an add there as well, and then simply worked it down into my target. And that was basically it. And there was actually one more potential entry, which I did enter, which because it flew, oh, sorry about that, one sec. Because it flew straight up into this level of resistance. Remember, that's a major level, right? It's a major level. So you can short up against that, give it tight risk yet again. Doesn't look like much, but it's more than enough. So all of these were taken fairly small size here today because of the nature of the market and where we are. It's very easy, and I'm well aware that this thing can squeeze. So on this short, trading it multiple times, I ended up locking in $1,440. And each one of those trades are confirmation trades. Some are quick, some are more mature, but they are confirmation of weakness trades. That's why I went short by buying puts. Now let's talk about this long. So you're going to see a real small profit here. And that was by design. So today, because I'm doing live trading, there was a real nice opportunity to teach traders how to manage risk due to size. Okay. So you can manage your risk due to size. This whole channel is our risk. Enter here. There's another level here that if it continued straight down, we would add. If it bounced, we would get out. If it didn't want to bounce and it came straight down to here, we would add. If it bounced, we would get out. If it confirmed lower, we would then obviously stop out of that trade. Okay? Come on. What the fuck is going on here? It's really annoying. Well, I don't know what the hell's going on. That's all right. So it looks like it's really far away here. It isn't. It's actually less than a point. It's about 80 cents risk on a almost $600 stock or ETF. It's very deceptive. It looks very far away. It isn't. But what I wanted to, one sec. What I wanted to show the traders and teach them is sometimes, even though you take a look and you snap your crosshairs and you calculate your actual risk of about 80 cents, distance matters, okay? It's perceived distance. And what can happen here, and I'll explain this. Sometimes 1 point of risk can look like this much space on the chart. Very small, right? Sometimes where 1 point of risk can be this much. It's a little bit wider, but still looks, about a point. It's fine. And then we have today where this is 1 point. It's very wide. It seems very wide. It might only be 1 point per share risk, or 80 cents in this case, right? But it's not technically more than that, but it's more than that. And the reason for that is if it were to break this and start grinding, you're going to see a massive meltdown in your options. And actually, we saw that right in this area when it started to come up into these highs, which is in here. It melted very, very quickly, like very quickly. So when you're dealing with that, it's like you can almost, it's really difficult to explain, guys. I'm trying my best to explain how to put this so then you guys can recognize it. I think maybe we'll leave that there where it is, there are times when that distance, it might only be a point, but if it's very wide and looks to be very wide, you need to size down, because that's when these market maker games can absolutely be played, especially if you're playing options. So what I did in this case, because there was high probability that this could easily continue to sell off, so I entered coming into that level, Remember, again, there was one more support level. This was my risk. We would add into that. It bounced. Okay, nice. It bounced. But if it would have kept coming down, because I started with such a small amount of contracts, I could hold that all day long. It wouldn't matter if it was real grindy action. It wouldn't matter because it was such a small position. And sometimes we need to forfeit or sacrifice profits for trading properly and thinking about our risk. And that's really the lesson. So I locked in 70 bucks on that trade, an absolutely beautifully executed trade. Executed here, paid myself on this one, yeah, executed here and paid myself as it came up into this level of first resistance. And that's all that is. Very easy trade. Sure, there might have been a way to hold this to capture a huge move, but I'm not interested in that. And for those of you that are looking at this, that would, for those of you that would look to execute something like this long on a Friday, because this is a valid level, you're really playing with fire. Okay. The question becomes really, where are you risking off of? And you have to look at the grindy nature of the action before that. So it's very easy to look at things after the fact and take a look and be like, oh yeah, I made the right decision. But I don't think that is, not on a Friday, not with how the market's been trading this entire week, where it likes to fuck around a lot before it picks its true direction. And you're going to get yourself into trouble. So it's always just best to err on that side of caution and think about your risk first, especially if you've already traded and you've locked in profits on the day. I think that's something that a lot of traders that are not professional traders, they're not full-time traders, and they don't prepare themselves for that. All they think about are profits. So they continue to take a million trades. But as a professional trader, your goal is to pay your bills. Once you've paid your bills on the day, that's it. And you need to look at it too, like locking $1,440 in plus an additional 70. Okay. So let's just call it $1,500 for the sake of argument. Is that not more than enough for 15, 20 minutes of work? I think it is. I think that's fucking killer. Like, I don't think about profits, nor do I judge my trades on how good or bad they are based off of profits. The way that this long was executed and managed and with targets in mind, I'm super happy with this. And I made 70 bucks on it. A guy that makes a ton doing this is still content with $70. So you got to ask yourself, why aren't you content with making what you're making, right? Sometimes trades don't need to be huge, right? Sometimes trades, actually all the time, if you're just trading to trade well, the profits will come, right? So I hope you guys have a great weekend. If you want to come learn how to do this and start fresh next week and you're tired of fucking around in your accounts and circle jerking yourself to death, come to tricktrades.com. If not, I'll be here next week with more free shit. It's just going to take you forever to put it together, guys. That's on you, though. That ain't on me. Have a great weekend, guys. Adios.